Hey, good afternoon, everyone. My name is John Jimenod, Regional VP of Sales here at Angel Oak Mortgage Solutions. We'll get started here in about a minute and a half. Let everyone get logged in. This is going to be recorded. We will get this recorded out to you before end of day tomorrow. And everything we're going to do today is right on our website. So this is not a PowerPoint. There's nothing that you have to prepare for. Everything's going to be driven from our easy to use website. So we get started here. I'll introduce our subject matter experts in about a minute. So hope everyone's having a great day. I was able to be down in San Antonio the last few days at the Texas Mortgage Bankers Association, which was really well attended and a lot of fun to be at. So was in Broward County a couple weeks ago with Scott and the East Coast team. So I'll see Stacy and Jerry in a couple weeks. So all good, all good. So give it another minute here. A lot of people still logging in. Again, today's a deep dive into our debt service coverage ratio program. Next week on May the 11th, we will be doing a how to find non-QM borrowers. And on the 18th, we will do a deep product dive into our bank statement program. So, all right, let's get started here. Stace, I know you've got something going on in the background. If you want to introduce yourself, Stacy.
Thanks. I am Stacy Flanagan. I am down in the Tampa Bay area, Sarasota, and up over to down to Fort Myers, and up and a little bit over into the Orlando area. I've been with Angel Oak since the end of 2013.
And then thank you, Stace, and congrats to your Lightning for pulling one out. So, and Scott, please introduce yourself, please.
Yep. Good afternoon, everybody. My name is Scott Grubel. I'm an account executive here in Broward County, South Florida. Been with Angel Oak since 2016.
And thanks. We have the two of the best in the business, East Coast and West Coast of Florida represented. And again, my name is John Jimenod, Regional VP. I get to work with Scott and Stacy every day, so it's truly an honor to have you guys on here. So without further ado, let's get this started. We're going to do a quick poll question here. Who on this call has originated a debt service coverage ratio loan in the last 12 months? And guys, I'll share some stats with you. I think it's 36% of the homes in the U.S. are actually rental properties, and this program continues to grow, gets easier to use and close loans in. So what do we have here for poll results? Wow, it ceases to amaze me. Wow, 78% have not closed a debt service coverage ratio in the last 12 months. So that's great. That's why all of you are on this call, and hopefully with the two best in the business, we're going to teach you how to not only market these programs, we're going to teach you how to price these programs, but more importantly, we're going to teach you the ins and outs of this program. So Scott, let's talk about our debt service coverage program here. Let me get this up. Take it away, Scotty.
All right. Yeah, and really excited to be able to talk about the program today because we have basically reinvented this program. It's the rebirth of the Angel Oak DSCR program. Really over the course of the last couple of weeks with all of the different features that we've added to the program. As a loan originator, if you're working with investors, this is a program that you must be very familiar with and you must have in your tool belt, because any experienced investor, and we know there's a lot of people out there doing the short-term rental thing, Airbnb, VRBO properties, they are going to see tremendous value in this program. And for most of them, frankly, this is probably going to be one of the only ways you'll be able to qualify them outside of a hard money loan, which we all know is going to be a lot more costly for your borrower. So let's go over the highlights of the DSCR, and then we'll start to talk about all the different nuances and the flexibility that this program offers you. In order to do a DSCR loan, you must have a 680 credit score, 680 credit score. And this goes up to an 80% loan to value on a purchase or a rate and term refi for a single family, condo, or a PUD. If you have a multi-unit property, then we go up to 75% on a purchase for a multi-unit. For cash out refis, we can go up to 75 LTV for your single families, PUDs, and condos, and we can go up to 70 LTV on your multifamily properties. So as you can see, you're able to basically do all of the above transactions: purchase, rate and term, and cash out. We recently just expanded the loan amounts on the program to 2 million, which is big because, as we mentioned earlier, we have a lot of investors that are starting to buy some higher priced properties for the purpose of short-term rentals. And so we're up to 2 million on these loan amounts, which we're excited about. On the flip side, we do go down to 75,000. So if you have any of those investors that like to maybe gobble up some of those smaller condos and whatnot out there, we can accommodate those loans in the program as well. The program, as you all know, the way the DSCR program works is it's based 100% off of the cash flow of the subject property. That's how the qualification is determined. So what does that mean? That means that there is no income verification, there is no employment verification, there are no ratios considered on this program, and we'll go over later on how a 1003 should look. But basically, we don't need any of that information. We're strictly looking at the rental income that the subject property generates, and we're going to use that rental income to qualify the loan. And there's many different ways we can do that now, and we'll discuss those. Now, really cool feature about this is that you can close in an LLC. For investors, this is big. Most people see, the majority of investors want to close in an LLC because there's a lot of tax benefits, and there's some extra layers of protection that they get by owning the investment property in the LLC. And obviously, if that's the case, that eliminates conventional right off the table. So that's why I say this is a very valuable program for you guys. Now, we do ask the borrower to own a primary residence if they're doing a DSCR purchase. Why? Well, we want to make sure that the borrower is not using this program to purchase a property that they could end up moving into, right? However, that being said, we do have flexibility here. One of the things we always like to say is, 30% of the loans we close carry exceptions. And so if you have, for example, an experienced investor, owns multiple investment properties, has a history of doing this, and also has a history of having rented or leased out their current primary residence, we're going to look at that situation as a potential exception. So keep that in mind there as well. As I mentioned earlier, purchase, cash out, rate and term can all be done. And the next feature, our 40-year interest only feature, can be applied on any of those types of transactions. So this is another big one, guys. I personally feel it's underutilized, especially in today's market, because for an investment property, when your investor's purchasing that property, the key for them is it's all about cash flow, right? The lower they can get that payment, the more cash flow they're going to generate on that property, and they're obviously going to get their appreciation as well. So if you can put them into an interest-only payment that significantly reduces that payment on a monthly basis, you're instantly creating more cash flow for that borrower. More importantly is that we have added a new feature where we can qualify the debt service coverage ratio, the DSCR ratio, using the interest-only payment. This is huge. In the past, you had to use the fully amortized payment. If your borrower qualifies for an interest-only, we can now just take that interest-only payment and we're going to divide the rent by the interest-only payment to come up with our DSCR ratio. So that's going to qualify a lot more of your buyers. On loan amounts over 1.5 million, we are going to ask you for 2 appraisals. That's pretty standard in the industry. And then the next feature I'd like to talk about is non-warrantable condos. So we allow non-warrantable condos not only on this DSCR program, but on any program that Angel Oak offers. Again, in the South Florida market, this is big. In all of Florida, for that matter, this is big because we have a lot of condos down here. And with all of the changes that Fannie and Freddie made to condos after the Surfside incident a couple years back now, there's a lot of new requirements in the terms of inspections for these condos. So I saw a statistic out there actually recently that said the estimate is, I think it's over 60% of the buildings in the state of Florida are now considered non-warrantable or not Fannie Freddie approved. That shows you how big of the pool is that's out there. And so we're able to get those loans done for you on this program. And as I mentioned, all of our programs. Now, there's a lot of things that would make a condo non-warrantable, right? It could be lack of reserves. It could be inspections, as I mentioned. It could be a high investor concentration amount. Maybe there's some litigations in the building. We have solutions basically for all of those issues. Each one of our guidelines is going to be way more flexible than what you're going to see on conventional. So to give you an example, the most common one we see is a lack of reserves. On the conventional side, you guys are used to looking at the current year budget, and whatever it says for reserves on that budget is what you're going to use to qualify the loan. And if it doesn't meet the Fannie Freddie requirements, of course, you're not able to do that loan. Well, we do it a little bit differently on our side. We're going to look at and take what they're collecting on the current year's budget, but we're going to add that to any funds that association may have set aside from previous year's collections. And that total is what we're going to use for qualification of their reserves for the project. So that's a big one. What we usually see is a lot of the buildings that are not collecting the full 10% in the current budget are doing so because they voted not to collect such a big reserve because they already have funds set aside and they're funded well from previous year's collections. So that's a big one, guys. That's another one I think will add a lot of value to your business. Condo tells. So we do non-warrantable condos. We also allow condo tells on the DSCR program. Another big one, because obviously with condo tell projects, the benefit that the buyer has is a lot of times these are already used for short-term rental. And in many cases, the hotel itself assists in renting out those units. So there's a lot of cash flow coming in the door, and a lot of these are located sometimes right on the beach, for example. So we are now able to do condo tells on this DSCR program, which is another big value add for you guys. And lastly, again, this is hot off the presses as well. We are now allowing business purpose only loans. So what this is basically gives you the ability to close a loan in a state that you as an originator may not be licensed in. We have a list of states here on the website that you can currently do that in, and that list of states is continuing to grow. So you could take a look at them there and please revisit because there will be more states added. Basically, as long as your borrower is closing that loan in the name of an LLC, it's a business purpose only loan, and you can close and fund that loan in a state that you're not licensed in as an originator. So again, as you can see, guys, to summarize it, there is a lot of flexibility on how we can qualify your borrower. I'm going to go into the actual qualification of the debt service coverage ratio real quick. And the beauty of this is there's many ways for us to calculate this for you. So your standard property ideal situation, the 1007 gets ordered, the market rent covers the proposed mortgage payment. That means you have a DSCR ratio of 100, maybe higher, and you're good to go. But what happens when the rent comes in lower and it's not covering the DSCR ratio? Well, we have options and solutions for that. If your borrower does a 75% loan to value, we actually have the ability to waive the DSCR requirement altogether. So it really doesn't matter what the rent comes in at, you can use that feature and waive it. As I mentioned earlier, we could pivot to interest only. If the borrower qualifies for interest only, we can look at the interest only payment. Maybe the fully amortized payment didn't get us to where we need to be on the ratio, but the interest only payment does. So there's another option to get it done that way. There's many different things that we as account executives are going to look at and help you guys with when you send that file into us for a pre-approval to make sure that the file and the loan qualifies.
Yeah, Scotty, a lot of great information. We have a lot of questions coming in. We're going to get to those questions in a couple minutes. This is a true deep dive into our debt service coverage ratio. We also call it our investor cash flow, one and the same. But as Scott mentioned, a lot of recent great enhancements to help you guys capture more business and close more loans. Stacy, take us through what you like to see on the 1003, what you don't like to see, and then tell us how the borrower qualifies for credit. So if you don't mind taking us through that.
Yeah, so guys, on the application, like Scott said, you have to own a primary residence. So you're going to list all of their current primary information. As account executives, when we get a pre-qual, one of the first things I do is I jump on Zillow or Realtor.com. I make sure that their primary is not listed for sale. So we want that primary information on the 1003. We don't need any income. We don't need any employment. We don't want to see it, even if they're retired. Don't mark retired, nothing. Leave your income and your employment sections blank. Don't want to see any of that information. One question I do get a lot of is, do you want me to list the assets? Yes, I want you to list the assets, especially if there's an exception to be made on the file. For whatever reason, we need an exception, then I want to make sure I have a strong file. So even if it's a cash out and I'm using the cash out for reserves, but I need an exception and they have a bunch of assets, set aside in their 401k, that's going to build a stronger file and be more likely to be able to get me an approval on the exception. So list your assets, no income, no employment. As far as your REO section goes, if they own a bunch of properties and they're in their LLC or a corporation and they're not on the borrower's credit report, so the borrower's not technically personally liable for that payment, you do not have to put them on the application. It's going to save you time, it's going to save the borrower time and the underwriter time. So again, if they're in an LLC and not on the borrower's credit report, you do not have to list all their properties on the application. Now, on the counter of that, if they have it in their personal name, we do pull a fraud guard, so it's gonna come up. So if it is in their personal name or on their credit report, then yes, please do list them in the REO section. I know a lot of you can't put in the property address for the subject property. So a lot of times you're giving us the pre-qual as a TBD, which is totally fine. We do pre-quals with a TBD all the time. I might reach out, or Scotty might reach out and ask you what the address is for the subject property. Reason being, I like to compare, make sure it's truly an investment property. The subject or the primary residence is worth 300, 400,000. They're purchasing $1 million property and saying it's going to be an investment property. I want to take a look at that. Do they live in a single family that's 2,500 square feet and the $1 million property is a condo, 1 bedroom, 1 bath? Even though it's worth more than their primary, it makes sense that that's going to be an investment property because it's smaller, it's a condo versus a single family. So we might reach out and have you just let us know what that property address is. Other than that, the declarations, mark everything properly, and that's pretty much it on the application. It's pretty easy.
Yeah, and you can tell working with Scott and Stacy that they know their stuff, right? They're going to do that homework for you up front, but obviously, the schedule of real estate is important, and as Stacy mentioned, assets are always something that helps us get those exceptions. So, Stacy, just touched. I don't know if I was reading some questions, and just so everyone knows, this is being recorded. This will be sent out before end of day tomorrow. If we don't get to a lot of these great questions, we will have your account executive reach out to you. We do have a lot of great questions coming in, so definitely get to those. Stace, just talk about credit. I know Scotty touched on credit score. What do you look for on trade lines and stuff like that?
So like Scott mentioned, we need a minimum of a 680 mid score. We are looking at trade lines. We want to see 3 trade lines reported for 12 months or 2 for 24 months. Now they can be closed as long as they were closed within the last 12 months. So if their date of last activity was in the last 12 months, that's fine. We can use that as a trade line. So we're going to look and make sure that they have those requirements. It's not much. So it's pretty easy to meet those. Are there exceptions to that? Absolutely. We're very gray. It's not a run DU approved or not approved type deal. We run in the gray area with our non-QM programs. So if it's not 100% there, or maybe there's a spouse and we can add the spouse and they'll give us some extra trade lines. So we have some options and some solutions for that. If they don't meet the minimum trade line requirements, just reach out to your account executive and they can go over those for you. Any bankruptcies, foreclosures, short sales, they do have to be seasoned for 4 years. So we don't want to see anything more recent than that as far as the housing, we call them housing events. But we do allow 1 times 30 on their mortgage in the last 12 months. Or if they've been no lates in the last 12 months, but maybe had a couple hiccups, 2 times 30 in month 13 to 24, that's okay. You know, sometimes things happen. You know, they're out of town or their auto pay didn't work for some reason. We get it. We understand things like that happen. So we're pretty, in my opinion, pretty lenient on the credit and on the trade lines. Another thing too, if you have a couple of borrowers, and this is something that your account executive will go over with you. I just pre-qualified one yesterday. It was either yesterday or this morning. I don't even remember. And the borrower had a 680 score, 686, and the co-borrower had a 786 mid-score. I'm like, let's take the borrower off, just do it in the co-borrower's name, which happened to be the wife. Since she had the better score, it increased bettered their rate by a point. Yeah. So that's some things that we're going to look at too when we do the pre-qual as the account executives. So definitely, you know, we're going to scrub that. We're going to look at the best option for your borrower.
Yeah, and you know, all of our account executives across the country are all seasoned and know these tips and tricks that Stacy and Scott have positioned. So, all right, guys, we are going to start going through some questions here. So, Scott, Janet's asking, up to how many units can we do this and at what LTV?
We can go up to 4 units currently. Stand by for updates on that. As I said, this is constantly being revamped and wouldn't be surprised if we saw that expand, but currently it's a 4-unit max. And that on a 4-unit, you can go up to 75% loan to value on a purchase and 70% loan to value on a cash out refi.
Yeah. And Stacy, Stephen's asking here, this is probably this one-off. I have a client who wants to sell his primary, live in a rental property, and then buy 3 investment properties with the sales of the proceeds of his primary. Can we do that?
That's going to be a sticky one, especially since he just sold his primary. Yeah. Our investors are going to look at it as he's probably going to move into one of these investment properties as his primary, and then maybe the other 2 as investment properties on the DSCR. So maybe he does the first one, moves into it. Now he has a primary, and then does the other 2 on a DSCR. Because don't forget, if he's self-employed, we do have that bank statement program as well. So, you know, no, we can't do the DSCR on a primary, but maybe he could go ahead and close on that primary if he's self-employed on the bank statement program, and then turn around and do the other 2 as investments on the DSCR. Another, and like John said, that might be a one-off, but another thing that we kind of look at too, if they currently rent, this guy in your scenario happens to be selling his primary, so it's not really the same thing, but if your borrower rents, but he has multiple investment properties and he's buying another investment property within about the same price range as all of his other investments, that's going to be something that we would look at doing on the DSCR program, even though he technically doesn't own a primary. So that's a true investor. He's got multiple investment properties. That would be an instance that we would look at allowing that, even though he rents a primary. And we do that on the first. Right. I don't know if Scott hit this point or not, but a lot of I get the question of, can you do this on a first-time investor? Yes, we can. And somebody asked me the other day, do you have to cut the LTV if they're a first-time investor? No, you can still go all the way to 80% on a first-time investor, somebody that's just starting to build their investment portfolio, which is super strong.
Yeah, Stace, that's a great point. This, you know, because, you know, everyone thinks debt service coverage, you know, no income, it's for that seasoned investor, but you're absolutely right. It can be the first-time investor. So, Stephen, we'll definitely get your account executive to reach out to you. Scott, Ron's asking, is there a prepayment penalty on these investment properties?
There is. The DSCR program carries a 3-year prepayment penalty. Actually, all of our investment property programs have a 3-year prepayment penalty. However, we do offer numerous options on that prepay. You can buy it down from 3 to 2, from 3 to 1, or you can waive the prepayment penalty altogether.
Yeah, it states, Ron asked again, another good question about high cost do these DSCR loans. And again, debt service coverage ratio. So you'll hear us use DSCR a lot, but it is for debt service coverage ratio program. Is there high cost on these loans?
No, so these are actually business purpose loans, non-TRID. We actually don't even do a pre-CD on these loans. We don't require that 3-day wait because they are not considered TRID loans. So you also don't have to worry about the high cost on these as well.
Thanks, Stace. Hopefully, Ron, that helps you. And then Scott, question back to you mentioned the ability to do a loan with less than 10% reserves being collected. Kind of go into that reserve question again, Scott, please.
Yep. So in the event that the building is not collecting 10% in reserves in the current year's budget, through our non-warrantable condo side, what we're able to do is we're able to take whatever they are collecting in the current year's budget, and we'll add that to whatever they have already funded from previous year's collection. So most of the time in our condo questionnaire, we'll ask the question, does the association have a separate reserve account, savings account, et cetera, that is funded? And if so, what's the balance? We're going to take that balance and we're going to add it to what they're collecting in the current year's budget. And that total is what we're going to use to meet the reserve requirement. Now, we don't require 10% reserves across the board. As a matter of fact, on the DSCR program, because you're at 80% LTV, at 80%, you're going to need the 10% if we use the combined there. But if we get under 80% loan to value, you can actually do 5% reserves. And if you go 70% loan to value and lower, we can waive the reserve requirement altogether. So again, a lot of flexibility there.
Yeah, that's great information, Scott. You know, and you're not going to get that from other than experts like Scott and Stacy. So, Stacy, so what we use the 1007 on the rent comp analysis. Talk about what if it's rented for less. Just kind of talk about rents being used, not used, when is it used. Kind of throw out some examples of when we use the rent comp analysis and vacancy and stuff like that, if you don't mind touching on that.
Okay, so we can use on a purchase, we do have to use what the appraiser puts on the 1007 as your market rent. So if your market rent on the appraisal comes in, you know, like Scott said earlier, 1-to-1, covers your full PITIA payment. That's what we're kind of looking for. Do we have options to go less? Yes. You know, Scott mentioned that with the cut in the LTV. Now, the appraiser has the ability to use long-term rental analysis, which they've been used to doing for many years. We only require the 1007. There's a 1007 and a 216. We don't require the 216, so that kind of saves them a little bit of money there. But on the 1007, they can also use a short-term rental analysis. If they use a short-term rental analysis, a lot of times, some appraisers will do it, some appraisers won't. I've experienced both. The ones that will, a lot of times if the seller provides them with the 12-month history that they've had on Airbnb or VRBO, then the appraiser can use the short-term rental analysis to give us our market rent for that particular area. If it's a refinance, we can use the existing lease or their short-term rental lease, which again would be a 12-month printout from VRBO, Airbnb, a company like that, use their 12-month printout plus 2 bank statements showing that they've been receiving that to kind of match what that printout has been for the last 2 months, but the printout's going to cover the last 12 months. We will use that as the market rent. Again, that's only on a refi. On a purchase, we do have to use what the appraiser puts on the 1007.
Yeah. Thank you, Stace. Like you said, guys, I mean, by the end of this call, you should be experts like Stacy and Scott are. This is just great information. And really, you know, we're going to get to pricing. We have a quick quote tool we'll show you. We'll even show you some of our marketing tools that you can access to help you grow your business. So but we've got a lot of great questions coming in here. Stacy, you talked on this a little bit. Husband has a 700 score. Gail's asking this question. 700 score. Wife has a 640 score. LLC 50/50. What would you suggest to them, Stacy? You're great at. You just talked about a tip and trick. So
that's a great scenario, and we do see that a lot. So if you're going to close in an LLC, anyone that's on the LLC does have to be on the loan. Now, in this case, what I would do as the account rep is I would say, okay, if you want to close in that LLC, then I have to use the lower of the two mid scores. Here's the rate. If you want the rate of the borrower that has the higher credit score, then either we close in his personal name, or he can create a new LLC just in his name so that we can give him the rate benefit of his score. The LLCs don't have to be seasoned any length of time. So he can create that new LLC tomorrow or today, closing it tomorrow. So I would kind of go over both scenarios and, maybe leave it up to the borrower. If she's true, they truly want to close in that LLC, we are going to have to go off the lower credit score for that rate.
yeah, great stuff, Stacy. Scott, Brandon's asking, what's the closing timeline on these loans? And I know you post this a lot, Scott, out on social media.
Mm-hmm. The beauty of the debt service coverage ratio loan is that they fly through the system. If you think about it from an underwriting standpoint, there's no income to underwrite. There's no employment to underwrite. We're really just looking for the appraisal, and then we're going to look at the assets and some other basic information. It is not uncommon for these loans to close within a week. And in some cases, we've had, some that came with an appraisal transfer and closed even quicker than that.
Yeah, great. Brandon's asking another great question. How long, Stacy, do you have to source and season funds? You might want to listen to reserves also.
Yeah, that's a great question. We only require source and seasoning of funds for 30 days. So if they are getting it from their mattress or another source that we don't allow, I have no filter, John.
You're just too good.
I'm throw it in the bank now. Let's season. We can still process the loan, get it with the underwriter. Don't submit the asset statement until I have a full 30-day statement where I don't see a large deposit. If I see a large deposit, we're going to have to ask where that came from. So wait till that next deposit drop or the next statement drops. Give me that one where there's no large deposit and there's your seasoning of 30 days. As far as reserves go, it's 6 months reserves just on the subject property. So it doesn't matter on all their other properties or even their primary. We only require 6 months on the subject property. And if it happens to be a cash out refi, we'll use the cash out to cover those reserves.
Yeah, great question. So Stacy, you're making me sweat a little here. Again, tips and tricks, right? So, Scott, the question about the LLC, but do we report this on their personal credit? It's a great question.
We do, yes. At the end of the day, we're allowing the vesting to take place in the LLC for title purposes, deed purposes, which is going to give that borrower all of the benefits that they're looking for in terms of taxes and protection. But we do underwrite the borrower individually, and so the loan will report to their credit report.
Yeah. And then, Stace, I know do we allow gift funds? It comes back to a little bit of what you just talked about.
This is what I was talking about. This is what I was alluding to. No, we don't allow gift funds on an investment property on any of our programs. So no gifts on investment properties. However, we only season our funds for 30 days.
Stacy, how long do we season funds for?
30 days.
There you go. There you go. So and we talk about first-time investors, right? Scotty, talk about cash out, right? We're starting to see a lot of this now. Because we've seen, especially in Florida, we've seen great appreciation. Talk about cash out and maybe touch on delayed financing, please.
Absolutely. Specifically for experienced investors that may already have a portfolio of properties, I'm seeing a lot of them tapping into those properties, leveraging the equity they have and cashing out. And then they're using that cash to go invest into other properties. We have all heard about the Burr method that's out there, right? So that's what a lot of these investors are doing. And the beauty of the DSCR program is that we can go up to 75 LTV cash out on a single family PUD or a condo, and 70% LTV on a multi-unit. So highly recommend that. And as far as any investors that may have purchased a property using cash, or maybe they were in a pinch and they used a hard money loan to purchase an investment property just to acquire the property, they can then come back to us and do a delayed finance transaction as long as it's within 6 months. So if it's within 6 months of the purchase date, we're going to use the purchase price for LTV purposes, but we can allow that borrower to pull back some of the cash that they used when they purchased that property. Now, flip side, on a standard cash out refinance, and this is a big one, we only require 6 months of seasoning to use the appraised value. That's unlike most lenders out there. 6 months of seasoning, we can use appraised value. So keep both of those in mind when you're looking at a cash out.
Stacy, Melanie loved your cash out. Melanie loved your mattress money. So, gotta love that. Gotta love that. Hey, Stacy, and it's coming into more and more transactions lately. What are seller concessions on the debt service coverage ratio program?
So on investment properties, we allow 3% seller concessions.
So, and we're seeing that, right? Scott's shaking his head. Yes, we're starting to see a lot more seller concessions come into play here. And we talked about the seasoning for cash out. So Craig, hopefully that answered your question. Let's talk on, we're about 35 minutes past the top of the hour. Let's talk about our, because it rolls up underneath there, Scott, if you don't mind talking about our foreign national program.
Absolutely, yeah. The foreign national is housed under the DSCR program. In other words, our foreign national program is done as a debt service coverage ratio loan. What that does for you as in a loan originator is it gives you the easiest foreign national loan you're ever going to close, because we're literally looking at two things on a foreign national under the DSCR. We're looking at the visa, of course, to make sure it's one of the visas that qualify, which we have a list of here. And of course, if the country is not required to have a visa, then we can do those as well, Canada, Italy, etc. And then we're looking at the assets. For the assets on a foreign national, we're going to source them for 60 days, and we do require them to be in the US for 30 days on a purchase. 30 days prior to closing, not prior to application. So if you're in the process of that, just went under contract, etc., we can quickly get those funds moved into a US bank account, and then we can wait on them to season for those 30 days and get them closed. We do require 12 months of reserves on the foreign national program, but the reserves can stay in the borrower's originating country. Only the funds to close have to be in that US bank account for 30 days. One of the new features we added to the foreign national program is these two can now close in a US LLC. And as you mentioned, it could be a newly formed LLC. Matter of fact, doesn't matter what state the LLC is formed in. So that's a big feature for foreign nationals as well. Now, as far as documentation, as I mentioned earlier, we're looking at the visa, we're looking at the assets. That means you don't need credit. You don't need income from the country. You don't need a CPA letter from their country. We don't need reference letters from their country. We've eliminated all of that documentation by doing it under the DSCR program. When the rent schedule comes in, we are looking for a 100 DSCR. So in this case, the rent does need to cover the proposed PITIA. However, the max LTV on a foreign national is 70%, which is industry standard. And we very rarely see issues where the DSCR is not covering at 70% LTV. If we do, we could look at restructuring. Maybe we get some cheaper insurance. Maybe we buy that rate down a little bit more, keeping in mind, as we said earlier, these are non-trade loans. They're no high cost. So you can buy that rate down a little bit further. There's a number of different ways we can work with you to get it done. But as I mentioned earlier, guys, this is going to be the easiest foreign national loan you'll ever do because we're only looking at those main items. And because of that, these also close very quickly.
Yeah. Yeah, the biggest thing, and Stacy Curtis is asking a question, does the foreign national need to own a primary?
We don't verify anything about their primary residence, whether they own, live with family, rent. We don't care. We don't ask. You're going to list their primary in their country, but we don't ask to verify any housing at all on that. And to kind of piggyback off of the assets being in the US for 30 days, if you don't meet that one-to-one, I kind of get, if the borrower has the ability, I kind of ask my broker or kind of train my broker to ask them to throw a few more $1,000s into the US. If you don't meet that one-to-one ratio and they need to buy the rate down, like Scott said, or put a little bit more money down, those funds still have to be seasoned for 30 days. And this is due to money laundering purposes or reasons. So if they need to put another $5,000 down to get that into the one-to-one ratio, you don't want to have them transfer another $5,000 and wait another 30 days. So if they have the ability, throw, 5, 10 extra grand in the US, they can always transfer it back to their country after closing, just to have that buffer to meet that one-to-one, because we don't allow anything less than a one-to-one ratio on the foreign national.
Yeah, that's it. Stacy, between money laundering and mattress money, man, you're hitting on all cylinders today. But Curtis, that was a great question, Curtis, because we do require that, like in most cases, on the debt service coverage ratio for them to own a primary. So thanks for pointing that out, Stacy and Curtis, for asking that question. Couple other things, with all this geopolitical unrest throughout throughout the world, you have, when we talk about tips and tricks that Stacy and Scott are going over, think about marketing this foreign national, because they like to send their children to universities, right? And, a lot of them want to send their child to university, but they don't want to pay rent. So this is a perfect example for them to pick up a property for 4 or whatever plus years, and at a no hassle in closing, right? Just your down payment and reserves. That's it. So, and we do, Scott, do we do cash out on foreign nationals?
We sure do cash out up to 65% loan to value on a cash out for a foreign national.
Yeah. All right. So, Scott, I know we're about 15 minutes from the top of the hour. Stacy's getting something delivered. We got a lot of other stuff going on. A lot of people have asked about pricing. So I'm going to go back to our homepage, Scotty, and kind of direct me to where we get pricing 24/7.
Yep. So this is our homepage, angeloakms.com. I definitely recommend everybody on this call, when you get to this homepage, you're going to click on this non-QM quick quote, and that's going to take you directly to our pricing engine. I'm going to ask everybody on this call to please save this pricing engine to your favorites. As you can see, there are no credentials required to log in here and to get live up to the minute pricing from us. So it's going to be as simple as inputting the information for the loan. So John will put in there a loan amount. You're going to select your credit score from the drop down. Your LTV that's being requested, we'll say 70% here. We're going to ask you what state the property is located in, of course. In this case, it's Florida. Our housing history is 0 times 30. This is a single family residence. It's a purchase. We're going to go DSCR, investor cash flow, which is the last option you see there. And then you'll see a drop down that asks you, what are you estimating the debt service coverage ratio to be? We know that that's not going to be an exact number up front, but we're asking you to give us an idea of where you expect it to be. So in this case, we're going to say 1 to 175, investment property, US citizen. Now you'll notice at the bottom, there's no rates yet, because when we change this to an investor cash flow, you're going to see another drop down that pops up a little bit higher. That's going to ask to confirm if you're licensed in the state. The reason we asked that question is because, as I mentioned earlier, we're now offering the business purpose only loan where you can close out of state. So we're just asking you that up front.
Scroll up, John.
Oh, sorry.
So LO is licensed. Now, John clicked on that prepayment penalty box. As you can see, if you did, want to bring this down to a 2-year or 1 year or waive it, the options are here and it'll price it accordingly. If you wanted to add an extra year prepay, we actually give a rate benefit for that. So you have that option as well. You can waive escrows here if you choose to. The interest only option is here as well. We're going to keep those at no for now. And on a borrower paid compensation, you'll see at the bottom, we're going to tell you your requested 70% loan to value on this scenario. By the way, it goes up to 80. That's the max LTV for the program. And currently the par rate is 7.25. So if you said, well, I want to see maybe a little bit more options on the rate, and then I want to send this in to Stacy to have it pre-qualified. You click on that view rates button, and now you're going to see the full rate stack options for this scenario. There are rates available there if the borrower wants to buy the rate down. And there's also rates available if you wanted to maybe have a lender credit going back to the borrower. So we're going to go ahead and select 7.25 at par here. At the bottom, you'll hit select option. That'll take you to page 2. Page 2 is going to ask you for a 3.4 file. If you have it buttoned up, great, you can drop it in there. If not, just click next. And in the final page, you're going to select your account executive. So you'll select Stacy there in the drop down. Then you're going to input your company's information, NMLS number, phone number, email, etc. And you'll see that at the bottom, you're going to be able to drag and drop all of your documents. So your PDF version of the 1003, literally just drag and drop it in there. PDF of the credit report, drag and drop in there. If this happened to be a bank statement loan, you could highlight 40 bank statements and drag and drop them right in there. And you'll scroll down to the bottom where you'll answer 3 more questions on the credit history. Has there ever been a bankruptcy? None. Has there been a DBK discharge? Not applicable. Has there been a housing event? Not applicable. And then you'll hit submit. When you submit that, that goes directly to your account executive. So Stacy would get a notification that a pre-qualification has been submitted, a new pre-qualification has been submitted by such and such loan officer. And now Stacy knows to jump in there, start working on that pre-qualification to get it back to you as soon as possible. We're usually able to get them back to you within 24 to 48 hours.
And these are, and when I say they're easy, they're pretty easy to pre-qual, as Scott and Stacy have alluded to. Not only they're pretty easy, and they fly through underwriting also. So, but definitely 24 hours on the, because really what you're looking at that borrower's credit, their assets, and that's it. And hopefully, and Stacy mentioned this earlier, we will do pre-quals on TBDs, to be determined properties. So a lot of what we do is on TBDs. So, but like I said, within 24 hours, you'll have that pre-qual back to you. So that's, a lot of people have asked, how do I get your pre-qual? This is how you get a pre-qual to us. And again, we've got the best in the business doing these pre-underwrites for you. So, and as Scott mentioned, if it was bank statements, there would be additional buckets for you to drop bank statements in. And we are doing a deep dive into bank statements on May 18th. So stay tuned. So Stacy, we always talk about, how can we help brokers grow their business, right? Let's take them to our marketing portal.
Sounds good. So you guys do need login credentials to get to our marketing portal. What John and Scott went over with you, the quick quote and submitting a quick qual or pre-qual, you don't have to log in for that. That information is done with no logins. You just go right to our website. To get to where John is going right now, which is our marketing materials, you do have to have login credentials. If you don't have them, please reach out to your account executive and we will get you guys set up with them. So our marketing department is phenomenal, top-notch marketing. We do all of these for you. I mean, they're free to you, so why wouldn't you use them? But if you log into our website, you'll see up at the top where it says marketing portal. Click on that. And then John, I don't know if you want to go over, can you make that a little bit larger for everybody?
Yeah, let's do flyers first, Stacy. I will make that bigger, yes. And I will, and Kim, if I misspoke, I apologize. We are doing a deep dive into bank statements on May 18th. Next week on the 11th, we're going to do a lot of what we're going to talk about on the 11th is how to find these borrowers. So sorry, Stace, go ahead.
Nope, you're good. So if you look at what John just hit was the marketing portal, and then he scrolled down to where it says flyers. We'll customize these flyers with your information, your logo. You can even drop your disclaimer in there if your company requires a certain disclaimer to be on all your marketing materials. So you'll see it when you click on, John clicked on the investor cash flow flyer. Again, these are free for you guys. There's a foreign national, and there's even some flyers in Spanish down at the bottom too. So on this, the,
Sorry.
Okay, so on this, if you'll see on the left-hand side of the screen where you can drop a logo, you can drop 2 different logos and your photo. So this one, somebody created for a real, broker, Liana. So what happens was when you go in there and create your own, your information will populate on every single flyer that we have. So you only have to do it once. So again, you can put a logo on the left, you can put a logo on the right-hand side of the flyer, your photo, and then you're going to enter your name, your phone number, your email address, your address, what states you're licensed in. And then again, if you want to put your own disclosure disclaimer in that box, you're more than welcome to do that. And then you click on add changes. It will customize this flyer into your information. Obviously, somebody did this for Leanna already. And then when you go up to the top where you'll see, yep, that little tiny box, you can click on any other flyer that you may want to see. And as soon as you click on it, all of your information that you've already done one time is on every single flyer in there. You can take these to realtor offices, you can take these to open houses, you can print them and blast email them. Social media is great. Everybody knows social media is a hot topic right now, no matter what kind of social media you add. These are all done for you. Just drop them into your Facebook or Instagram or whatever the heck you're using nowadays. And it's already done for you. So what's great about these is you don't have to do anything. You can just drop one once a week, stay in front of everybody, stay in front, don't, out of sight, out of mind type deal. So you definitely want to utilize these. And again, why wouldn't you? It's free advertising for you guys.
Right.
We also have in the marketing portal, there's the social media. These are actually great little snippets. They don't go into much information. So if you just want to pick one about a loan that you closed, you can just do these little investor cash flow right there.
There you go.
So you can actually just do these. They're just a quick little snippet with the name of the program, and you might want to put it, hey, I just closed a loan for so-and-so utilizing this investor cash flow or DSCR program. It went great, closed it in 15 days, blah, blah, blah. Again, this is all free advertising for you guys. And another great, go up to presentations. Under the marketing portal is our presentations, realtor presentations. We do a lot of them. I know Scott and myself do a lot of realtor presentations with our brokers. We're there on your behalf. We're not there on Angel Oak's behalf. So these presentations are also customizable. So what I do is I send the presentation to whoever I'm doing the, whatever broker I'm using. They can customize every slide with their contact information and their company logo on them. So during the whole presentation, it's you guys being out there. It's you guys. We're just there as the expert on our programs, but we're there representing you as a business partner.
Yeah, Stace, it's, and Janet, Janet asked that question. Do you present for us on behalf of our realtor and referral sources? Janet, we love doing these presentations. There's nothing more than, getting your sphere of influence and educating them on non-QM. And as Stacy says, we go in there almost like witness protection program that we go in there and we're just, I'm going to use Janet because she brought it up. Hey, we're just one of Janet's investors, and Janet has access to a whole other assortment of programs, but we're just going to inform you about the non-QM programs that we provide to Janet. So it's a powerful, powerful presentation. 9% of the loans we close in our bank statement program are actually for realtors. So you get 12 realtors in a room, the odds are you're going to close one of their loans. So it's a strong, strong, powerful presentation. A couple things, Stacy, you mentioned about, open houses. We've seen loan officers co-brand those flyers with a realtor partner. So you can co-brand those with your realtor, you'll co-brand them with someone else in your office, whatever. We will help you get those out and get them in front of your referral source. And, Scotty,
Stacey,
anything else to add?
Yeah, Stacy, one more thing. I think I might have missed it earlier. How much does this cost our approved brokers?
It's free.
Wow, incredible.
Free.
Maybe sit up there, let us go.
John, I did a presentation last week with a broker who actually ended up putting the presentation on social media. But what he did was he took my realtor presentation PowerPoint, which is this, and he added to it at the end other programs that he did. So he's using our free advertising and customized it in his information. And at the end, he added lot loans, new construction. So he added his own slides to our already created. I think he added another 5-6 slides at the end of other, because again, we're there representing you guys. We're there on your behalf. So he just went ahead and added some additional slides with additional programs that he does that we at Angel Oak don't do. And he just added it to the PowerPoint. It was great.
That's brilliant. That's brilliant, guys. We're here to help you grow your business. And I hope, what you took away from Scott and Stacy, we are experts in this field. We've seen everything, right? So, and Scott and Stacy and all our other account executives across the country, they know how to ask that second, third, fourth level question to get you to say yes. They're not trying to push you to say no, but they want to make sure that that loan closes on behalf of you, your borrower, your referral source. So, Scotty, anything else in closing?
No, I mean, we look forward to working with everybody. We appreciate everybody hopping on here to go through this deep dive with us. I will say in closing, guys, in the current marketplace, there is a lot of competition in the non-QM space. You're seeing a lot of new companies jump. And I think it's important to say, as an originator, you want to choose who you are trusting your loan with wisely. There's a lot of shiny objects out there being flashed around, and it's very important to make sure you're working with a company that's got a track record of having closed these loans and are very experienced at closing these loans. We're always proud to say we are the longest tenured non-QM lender in the industry. That's fact. We're the largest by volume. That's fact. The point there is that at the end of the day, we're going to get your loan closed, and that's all that counts. So keep that in mind when you're selecting who you want to do business with or who you want to trust with your loan. Again, there's a lot of competitors out there, which is great because Angel Oak can't do every non-QM loan. But again, you want to develop a relationship with your account executive and work with a tenured company, a tenured AE, to have that trust and faith of knowing that loan's going to close for you.
Well put, Scotty. Stacy?
Yeah, those are great points. And keep checking back. Like Scott said, we can't do everything, but a week ago we didn't do condo tells. We only do units. A little birdie said we might be looking at more. So always check back with us, even if you think we can't do it or it's something that we may not have today. Check back, let us know what you have. We might have it tomorrow. You never know. So right now we don't do everything, which is fine. But always check in with us first. And we really appreciate your guys' business and look forward to doing more loans with you guys and making 2023 successful for us all.
Yeah, well said, Stacy. And just between, the three of us, we have almost 25 years of experience just at Angel Oak. So like Scott said, make sure you're working with a true professional, which Stacy, Scott, and all the account executives at Angel Oak truly, truly are. So On a couple other, next week is May 11th. We're doing how to find these borrowers, how to market to these borrowers. So we'll dive in a little deeper on our marketing platform. And then the following week after that, on May 18th, we'll do a deep dive into bank statements, which is a huge, huge popular program. And then on behalf of everyone, this is going to be recorded. We will get this out to you before end of day tomorrow. If we didn't answer any of your questions here, we will have your account executive get back out to you by no later than tomorrow morning. But on behalf of everyone here at Angel Oak, thank you for your time. Thank you for your business. And we look forward to working with those who have not closed loans with Angel Oak. So thank you, everyone. Have a great afternoon. Scotty, Stacy, love you guys.
Love you too, John.
Thank you.